As a regular part of our estate planning practice, we create certain trusts that are called life insurance trust, irrevocable life insurance trust, or ILIT for short. And the basic purpose of creating an ILIT is to get the death benefit of a life insurance policy outside someone's taxable estate. We're holding now in about 2017 and getting ready for 2018, we're currently holding at about a $5.49 million exemption per individual, which means that you're able to transfer $5.49 million of net estate to the next generation without incurring an estate tax. And if you're married, you can double that up to roughly be about $11 million of net estate passing to the next generation without incurring a federal estate tax. But now when you add a life insurance policy, you've now increased the value of the estate by the amount of the death benefit. And so some people always say to me, well, wait, I thought that the life insurance policies were tax-free. And the answer is that's right. It's income tax-free to the beneficiary, but the death benefit is tax inclusive for purposes of the estate tax calculations. So being sensitive to these items, the government has given us a specialized tool to take these life insurance death benefits, which were pretty much designed for liquidity of the estate, surviving spouses benefits for a family to make sure there's enough money there if some family member dies too soon and now you're without those source of funds. They want you to have those funds. They want you to preserve those. So they create a special vehicle called this ILIT, this life insurance trust, so you can continue to have those funds for the benefit of the family without it being consumed by estate taxes. The challenge is that there's certain formalities that come along with this ILIT thing. You got to have bank accounts. You got to have what are called crummy notices. You have to have tax returns that are due. There's certain formalities. As a matter of fact, there's probably about a 15 or 20 point checklist that we deal with to make sure that the trust complies with all the IRS requirements to keep it separate from the estate. I give people a corporate analogy. Most people are familiar that corporations as limited liabilities entities are designed to keep a liability away from the individual. It wasn't my activity, it was an activity of the corporation, therefore the liability should be contained within the corporation, a limited liability structure. And there's formalities that come along with that to basically, to show its separateness. They'll have corporate formalities, they'll have stock certificates, they'll have bylaws, they'll have corporate minutes, they'll have separate accountings, they'll have tax returns. So whenever a company gets sued, as lawyers, we typically ask for a copy of the corporate kit. We want to see all of these formalities. We want to see the minutes. We want to see the separate accountings, the tax returns, the issuance of the stock certificates. We want to see and you respect all the formalities, because if you're truly going to hold it out as a separate entity, you want to see that you yourself are treating it as a separate entity. That plays along over with the ILIT thing. In order to make the argument with the IRS that these funds are separate and distinct from you, you change the ownership to the ILIT, you change the beneficiary to the ILIT has its own EIN number, the ILIT has its own bank account. There's certain things that are happening on premium payments and deposits. There's certain things that are happening in regarding of a case called in-rate crummy. There's certain timing that has to happen. If it has a type of portfolio that may produce an income, there may be certain tax returns that are due. You want to make sure the policy is evaluated to make sure it's a good quality insurance policy to perform as advertised. In other words, there's formalities. Therefore, when the IRS comes knocking, you can say, look, IRS, this is a separate entity from my estate. As a matter of fact, and I've treated it, here's all the formalities to establish its separateness. And therefore, it will be taxed outside the estate, which ultimately is the main purpose for both business succession purposes as well as for family survivorship and needs purposes. So I tell you this because it's a question that comes up quite frequently, and I serve a lot in the capacity as the administrative trustee for these life insurance policies, these life insurance trusts, to make sure that they stay separate and distinct during the client's lifetimes, that the ILITs will work as advertised. So if you happen to have an ILIT, whether it's yourself or maybe your parents, and you want to make sure that it's going to perform as advertised, and you're concerned about the formalities of the trustee, they may not know what to do. You want to make sure that those formalities are respected. Give me a call. Let's have a quick look at the ILIT. Let's take a quick audit of the formalities, make sure they're being respected. And if necessary, we can even find ways to kind of change and substitute those trustees out. So here again, my name is Brad Barth. I'm a partner here at Barth Calderon, where we plan today for all of your tomorrows. Thank you for your attention. Bye-bye.